All right, we're off to the races. Hello, everyone. My name is Dan Mahoney. I'm a managing director with TruSight. We're a lower middle market buy-side deal sourcing platform. This morning, we are going to be recording a conversation to go into a little bit of detail to debrief and go behind the scenes a bit of a survey that we had issued in the first quarter of this year. That survey covered three primary questions. One was, the first one was impact to deal flow between 2019 to 2020, given the obvious changes in the pandemic. The second was allocation of internal investment for investment firms. Travel and expense dollars largely went unused, at least the second half of the year. What does that mean for planning for this year and next? And then lastly, some recommendations to business owners, which could also be applicable to sell-side advisors in terms of how to run a smooth and effective process, deliver value to your client, or as a business owner, get the value that you're seeking in any kind of transaction process. So joining me this morning, I'm very happy to report we have these esteemed friends of the firm, Kyle Madden from KLH Capital, Jessica Ginsberg from LFM Capital, and Erik Dykema from Lineage Capital. And we're going to give a quick intro on each of those firms and then jump into the questions. So first up, we'll hand the microphone off to Jessica. Take it away.
Sure. Thanks, Dan. So I'm Jessica Ginsberg, and I head up business development for LFM Capital. LFM is a Nashville-based lower middle market private equity firm. We are focused on manufacturing companies, typically with between 3 and 15 million of EBITDA. We were founded by engineers and former operators, so tend to take a differentiated approach and like to find good companies that we can help make great based on who we know, what we know, and where we've been. Thanks.
Kyle, how about you?
Sure. Good morning, everybody. My name is Kyle Madden. I'm a partner at KLH Capital. We're a PE firm based down in Tampa, Florida. Been around since 2004. We're investing out of our fourth committed fund. It's a $200 million vehicle that we raised back in summer of 2019. We're looking to invest in companies that are making 4 million to 20 million of EBITDA, specifically within two business models, industrial services and value add distribution business models. So I like to look at it as we're really laser focused in those two business models, but once we're within those, we're very opportunistic. Just given we've kind of been around the block within these two sectors, we understand a lot of the inherent risk characteristics that are in these things. So think of things like customer concentration or branch level concentration or some salesman concentration or something like that. If the company has it, we can typically underwrite that type of risk because we know how to fix it. So that's really all that we're looking for is service and distribution. We do both majority and minority equity deals. You guys can all log online and take a look at our portfolio. We'll invest nationwide, but ultimately looking for good service and distribution companies to help out.
Super. Thanks. And the anchor position, Mr. Dykema.
All right, I'm with Lineage Capital, which is a Boston-based private equity firm. We're situational investors rather than sector investors. We invest only in owner-managed or family-controlled businesses where there's desire for a certain kind of transaction or partnership. So with our model, a business owner will get the majority of the value of the company in cash at closing. But we are looking for believers, people that want to keep a 30 to 50% or more ownership stake in the business going forward. And the most unique aspect of our model is that in all cases, even when we invest for majority stake, the rolling shareholders get to retain control of the board. It's a US only strategy. So we've got a couple of companies out in California. We've invested in specialty consumer business services. We have an optometry platform and a number of industrial businesses as well.
Super. Appreciate that, everybody. We're just going to roll right into the questions. So, we're not going to reiterate, or I'm not going to reiterate some of the answers or feedback from our survey, but thanks to, of course, everybody that was willing to click a few buttons over a few minutes and take it for us. But obviously last year saw a great impact in terms of all of your funnels of deal flow. And so from the survey question, we had different sources, predominantly sell-side investment banks, probably saw the biggest hit. We also know that there's elements or strategies around direct sourcing from an internal team, leveraging buy-side advisors for sourcing. And then there's sort of that network effect, right? Your sort of ecosystem. And so I'd love to just, again, go back around the horn, figure out where that impact driver, what that led to in terms of your year, understanding everybody had medium to maybe up years. but what does it mean in terms of your focus for sourcing strategies for this year and looking forward? And Jessica, we'll start with you.
Sure, absolutely. So we take, a fairly, I would say, diversified approach to sourcing. We really like to pull on all channels. So on the indirect side, that means sell side and buy side. And then we also have a really active direct sourcing platform where we reach out to business owners directly via phone, email, et cetera. And so, clearly 2020 started strong. It felt a whole lot like 2019, which was a record year. Mid-March, all of a sudden, the everything kind of, came to a grinding halt. And, we continued to feel, a pretty sharp decrease in new deals through the second quarter. Most definitely saw a pickup in Q3, which, really continued through the end of the year, although we did see a bit of a, I would say a downtick from right around the time of the election till the end of the year. Overall, indirect sort of sell side deal flow was down for the year. We were down about 20%. I think that I have heard from firms that are sort of more generalist in focus that they had up years or maybe on par years with 19. I think our manufacturing and industrials focus is really, why we felt that decrease. I think our sectors, have been a little bit slower to recover. And potentially, just the uncertainty that was in the market, especially leading up to the election, impacted our types of businesses more than others. On the direct sourcing side, and that we really decided to kind of pivot our strategy. I mean, in general, we are sort of a high volume outreach firm, and we decided, given just that, business owners were waking up to an environment that, in most cases they had never woken up to before. We decided to kind of go bigger, go broader, and just sort of see what we could get out of that. So we really put the pedal to the metal on the direct sourcing side. We saw response rates down about between 25 and call it 40%, depending on, what sorts of outbounds we were doing. I think business owners were distracted. They were busy. They were, running the shop, which is exactly what they should have been doing, during the kind of unprecedented times. But we were able to stay active. I think, looking back all in, it was absolutely a roller coaster year, but, we closed two new platforms in 2020, which was on par with 2019, closed a really sizable add-on at the end of 2020. So, all in, it was a fine year, but lots of ups and downs to get there.
Understood. Kyle, how about you guys? I understand with, it can be up and down, but if you're still getting deals done, on paper at least, it could look like a good year, but obviously the day-to-day might have been a little bit challenging. How are things looking out of Tampa?
Yeah, so a couple different things. When you think about the funnel, and then just internally has our model changed? The funnel, as many of us probably experience in any normal climate, our deal flow funnel, when you spread out all 12 months, it looks like the Golden Gate Bridge, right? We all work in a fairly seasonal business. So we're typically used to a busy kind of full court press from sell sides bringing things to market end of Q1, beginning of Q2, and then likewise, end of Q3, beginning of Q4. So hence the shape analogy there. Last year, obviously that slope or that shape changed considerably. I mean, our deal flow back end of March and April fell off a cliff. But then early spring to late spring to early summer, deal flow for us came roaring back. But here's what's fascinating. The type of situations that we were sourcing and seeing were different. What I mean by that is there weren't necessarily a lot of companies for sale coming to us per se. We were getting a lot more inbound calls with something like, hey, I've got 3 shareholders, only one wants liquidity, the other 2 aren't ready. Right now is an interesting time. Can you do a minority deal, right? So we were seeing a lot more of that. We finished the year with the top of the funnel down only 8%. What's very interesting is that the bottom of the funnel In terms of deals closed, we had a record year. We closed 6 deals, 3 platforms and 3 add-ons, which is great for us. Why is that? Or in terms of, have we changed the model? I think no. Our investment thesis, and again, to rewind, what we're looking for is industrial service and value add distribution businesses. So those businesses tend to do okay in downturns or questionable economic climate. So the investment thesis remains sound, continues to remain sound. I think the business development strategy or the go-to-market strategy continues to bear fruit. What we have pivoted or fine-tuned, I'll say, is a continued effort to focus really only on what we're excellent at. And that may seem obvious to us, but with processes getting tighter, more generalist firms entering the space, you have to be able, in our opinion, you have to be able to demonstrate and share, why you're the right fit to the referral network, whether it's your industry, your business model, or just personality, given what the shareholder goal and objective is. So we're laser focused in service and distribution, but quite opportunistic so that we can look at those deals where, it may be 5 owners, but 3 want to sell, or 2 want to sell, or 1 wants to sell, or there may be some concentrations, or, there's something in there where they need liquidity to accomplish something, but then, we can help them break through the glass ceiling, whatever that is. So our strategy has not necessarily pivoted at all, other than just to continue to focus in and hone in on those exact 2 business models, to show to the referral source network that that's what we're excellent at.
Sure. That sounds like it makes sense to me. I mean, obviously industrial services, especially when you get into the Jansan topics, I'm not sure if that would have been something of particular interest for you in April, but no shortage to those companies at least exploring strategic alternatives, we'll call it. Erik, your model actually might lend pretty well given,
That's what we've heard.
given some economic uncertainties. Situational investing that you guys are focused on sounds like it actually might be sort of the jack of all trades or a good fit here. And so I'm curious what you guys saw and if anything changed in the underwriting or where you were looking to source deals from last year coming into this year. Absolutely.
So again, just a reminder here, we invest only in owner-managed or family-controlled businesses where the desire for our kind of transaction. And again, it's 4 to 10 in EBITDA. And all of our deal flow is intermediated. About 75% of it comes through sell-side firms, with the remainder coming through buy-side firms. Our deal flow on the platform side was down around 25% for the year. Things were very busy through the end of February. Pretty much the only things that were out in the market for the next 3 months were either just terrible companies or businesses that have been very COVID impacted and still wanted to get paid off of 2019. I think similar to what Kyle said, the market really exploded for us. There was nothing going on in May, but it exploded in June and really continued to be quite strong, really right through about the middle of November. The overwhelming majority of the deals that we saw were businesses that were sort of on trend or sort of COVID indifferent, rather than businesses that had big COVID. You have to understand we were shut for 3 months. We didn't see a whole lot of those companies that were shut for 3 months and had a big pro forma adjustment. We didn't see a lot of those companies that had not been making hand sanitizer and suddenly got into that. We didn't see a ton of those. This year, just a quick digression here, the deal flow we've been seeing has been overwhelmingly concentrated in those COVID boosted businesses, whether it's every sleep company, sleep product company is for sale right now. So it's been a bit of a shift. In general, I'd say I think of us as a firm that tend to be focused on things that were not really COVID boosted or COVID hurt here. However, the ones that we actually closed last year, we closed despite the fact being down 25% in terms of opportunities, we had a monster year in terms of closings, 4 platforms and 2 add-ons. One of those 2 add-ons was a very large deal. So a big year from an execution standpoint. Of those 4, 1 was pre-pandemic, 1 occurred just right after the beginning, and it sort of held its own during the course of the year. And the 2 deals that were closed right at the end of the year were sort of the opposite deals. One was at least meaningfully COVID boosted. The other had been hurt pretty badly by it. So they sort of offset each other. I'd say that overall, most of the deals that we saw from the sell side were businesses that had that sort of were COVID indifferent. A lot of the things that we were seeing through our fairly active buy side program were the ones that were more COVID, HVAC contractors and things like that, more COVID boosted or COVID hurt.
Okay, well, good. I mean, I think this is going to tie into a little bit of the second question here. We had asked the survey recipients about essentially where you're investing or reinvesting. Maybe it's allocation of the travel expense dollars that didn't exactly get used last year, but tying into the sourcing side of things, obviously there's probably interest or expanding the sourcing in some capacity. Maybe there's need for underwriting staff. Maybe there's need for tech and sort of internals, sort of software and controls there. So I'm curious about internal investment for the firm this year, going forward, where you guys are sort of allocating the dollars. And this time around, we'll start with Kyle and go back around the horn.
Yeah, thanks, Dan. It's a good question. I wish we had something more groundbreaking to share with the crowd here, but I think like all three of us had mentioned, we had good years last year. So internally, I don't know that we found anything that needed to be tweaked significantly, or at least a significant reallocation of dollars. And of course, there's less jets flying around or that we're on. So I think by and large, guys, we stuck to the 2020 plan, continuing to stick with the 2021 plan, of course, kind of shifting the physical attendance to more virtual presences, and going through kind of the ebbs and flows of that, which is these virtual events, they're highly productive, but it is a slightly different crowd than who would physically attend an event. So we're not shifting, we're more just staying the course. I think that's largely due to the deal flow that we have seen. I think we would probably be rethinking things if our deal flow was down, 50% or something like that. But much to Erik's point, these industrial service and these distribution companies, by and large, I think the region of where they operate drives this, but by and large, they were deemed critical or essential. So thankfully, we didn't see that deal flow drop off. So we haven't shifted anything. I mean, we are bringing somebody new onto the team here in the summer, but that's not any sort of kind of COVID reaction or behavior. I mean, that was something that we discussed 12, 18, 24 months ago. Yep. So again, wish I had something more groundbreaking, but I think we've been putting up decent numbers. So I think we're gonna stay the course.
Maybe as things continue to open up here, we can all get a pair of the KLH sunglasses in the mail. And then we'll spend some more time outside.
Yeah. Or if you need 12 pairs, let me know.
Understood. Erik, how about you?
I think the only thing that is likely to come over the next few months here is more sort of experimentation with LinkedIn. Just speaking personally, I've never been really a social media kind of person, and my LinkedIn network is largely something where I've accepted invitations rather than sort of proactively build it. So to the extent that we sort of roll something out in that front, there will need to be a disciplined effort to sort of build out the network on that front here. But in general, I think I'm sure you've faced this just on your personal side here. It seems like every time I've spent $7 or $8 on a widget of any sort, I get nearly daily email, marketing emails from that firm here. So email marketing is a little tricky right now. People are getting absolutely bombarded. So we'll experiment with LinkedIn and see whether or not that can be helpful to us.
Okay, so it sounds like otherwise stay in the course then.
Yep.
Jessica, how about you? What's groundbreaking at LFM these days?
Sure. So, to piggyback on what Erik was saying a little bit, I mean, we have definitely amped up, kind of the marketing efforts. I think, business development and marketing have kind of blurred a little bit. And so we have absolutely upped our presence on LinkedIn. We did sort of a website redesign this year. We added some testimonial videos, just trying to be as impactful as we can, recognizing that, like Erik said, everyone is bombarded with email and sort of other e-communications, trying to make our point, make it fast, make it clear. So definitely amping up marketing. And then, this is really not related to COVID, but we are absolutely investing in business development, and I think it's a decision we would have made with or without COVID, but, COVID potentially accelerated it, just as, we're trying to be creative. We're trying to get out there, not necessarily physically, but connect with more people. And so we will be growing our BD team in the very short term to really increase, I would say sort of dual focus, indirect sourcing and direct sourcing, but just the ability to put more time there. And then I think over the longer term, we're really focused on how we can grow our portfolio companies, how we can take them to the next level, and how we can do that, most efficiently and while being the best partners we can be. And so we've recently invested in some more operating talent across our portfolio. Actually put out a press release just this morning about 2 new portfolio CFOs that we've added, who will really focus on kind of the finance function across our portfolio. And I think that model has worked really well for us, and we will likely expand that to other functions over time, kind of over the next, call it 12 to 24 months.
No, sounds good. I did see the email announcement. I should have mentioned at the top of the question, but super. Well, from our side, just to answer, since I can play panelist as part of this, we're investing in staff as well. And just to go on Erik's point, we're trying to spend a little more time on LinkedIn. We're obviously doing stuff like this, so we know that we're going to need some people, to join our team for this year and next as we're looking to grow. And it's mostly, how do you separate from the full court press and marketing that other firms are doing? What makes you different? Sometimes it's personality, sometimes it's sort of a culture you can imbibe or show, through some video content, for example. So I'll be watching, so, and trying to steal some good ideas from you all as you come out with this over the coming months. So to switch gears, slightly here, the third question of the survey, at least, was, what are your tips? What are your recommendations? Pretend that you're speaking direct to business owners or those representing them, how you can ensure not only a smooth process, which was certainly disjointed in certain ways last year, but also how can you kind of separate or plan for not just a smooth process, but be able to demonstrate what makes your company different to get, that higher dollar value is going through, any kind of M&A process. Erik, we'll start with you, and then Jessica, Kyle.
So I may try a little bit of a cheat here. The first one is the shorter part of it here, which is that I'd say right now, if you're a business owner and you're ready, you've got your financial reporting all squared away, and you've populated the data room, I would go right now here. Right now, deal flow is still continues to be at best mixed, and is sort of dominated by not particularly high quality opportunities. So if you were in the market right now, that would be a good place to be if you're ready. The other side of it is, if you're still getting ready and getting organized, being as absolutely as buttoned up as you can be, I think would be very logical here. I think most folks, even though things have gotten off to a slow start, think that the middle of the year will be plenty busy. And so being absolutely as buttoned up and as organized as you can be to sort of differentiate yourself during what will be, it's bound to be a busy season, would be pretty logical. One thing that we have not seen a lot of in our market, but I think there's very good logic to it, is I think a lot of people are aware of sort of sell side quality of earnings reports here, which have become absolutely prevalent in our market here. One thing which is occurring more in the sort of next rung up there in the private equity or in M&A world are sell side market reports here that I think a lot of firms are particularly concerned about. Look, some aspect of what has changed about companies in response to COVID is sustainable. Some of it isn't. So having a buttoned up story does help give people some comfort and some comfort that some aspect of the uptick in your business is permanent. I think would have a lot of merit to it.
Great points. I mean, we've seen sell-side QOV come out. I think the marketing report is interesting as well, because you all are going to do your own diligence on these deals, but it does show that level of preparation that you at least thought of it or had the ear of someone that mentioned a good comment there. So Jessica, how about you?
Sure. So Erik's points are absolutely dead on. Having the information, having the data, clean and readily available is really priority number one. I think what I would add to that is hiring the right advisors. As I mentioned, we do deals with intermediaries and without. When a business owner hires an investment bank, that's usually, a good choice, and sort of, strong accounting and legal follows that. Oftentimes when we're dealing with business owners directly, when there's no intermediary, they're inclined to call an attorney that, helped them, buy a building 20 years ago, or an accountant who, has done their taxes for years or something like that. I would encourage business owners to hire experts. If you're not going to hire an investment bank, that's fine. But certainly, find a deal attorney, find an accounting firm that, absolutely knows what they're doing, from a QOB perspective, et cetera. So that's always our number one, piece of advice. And then I would say, just to really make sure that you're picking the right partner. Obviously, value and cash in the bank is important, but also, thinking about culture, thinking about legacy, thinking about employees, and really for business owners to wrap their heads around what a change in control means, and what they want the next generation of the company to look like.
It's interesting, Kyle, before we go to you, I did hear the recommendation to make sure a business owner or intermediary has a reputable, attorney involved. I'm curious, Jessica, has it ever come up, given you just mentioned talking with business owners directly, has that ever come up maybe earlier in the process that you would recommend they reach out to someone, or have you assisted with that in terms of negotiations early on?
Absolutely. I think when there's not an investment banker involved, there's a lot of education that we're doing to these business owners, and that's fine. I mean, that's part of the process. But what can come with that is, you're kind of doing an education process, then the transfer of data takes a lot longer, deal fatigue starts to set in. And if there's no one on the business owner's side that's sort of, encouraging things to keep moving in the right direction, and reiterating that, hey, this is all normal stuff. Yes, they're asking for a whole bunch of information, but they need this information. It's hard. So yes. So when we are talking to business owners who are, maybe less sophisticated, or, maybe make that first call to a lawyer that doesn't seem like the best fit for the transaction, we will make that suggestion. And, we have gone as far as to say, hey, we're looking at a company in rural Minnesota. We're going to call some people we know are attorneys, investment bankers in Minneapolis. Here are 5 names of deal attorneys in the Minneapolis area. We don't know that, we don't know them, but we hear they're good. Call them, talk to them, see what they have to say. So we will absolutely help, if needed.
Got it. Erik, maybe a good use of LinkedIn as you guys get a little deeper into the mix on that end of things. But Kyle, how about you? Talking to the business owners, what's the recommendation?
Yeah, I think all of these suggestions have been spot on. I would add understanding and being able to articulate growth in your business. And that, that doesn't mean necessarily, hey, you've got to pitch us on why your company is going to grow 20% next year, but it's just having that section of slides, or having that conversation earlier in the first date or in a management presentation has been helpful. We've gone through a number of virtual management presentations where the growth section of the conversation is actually coming last. I would move that ahead to come like second or third. Reason being is when the market is so competitive like it is right now, and we are being asked to pay more and get more creative and strategic with valuations and structures, we want to hear not necessarily exactly what you as the business owner are going to do, right? Because you're picking up a partner, so 1 + 1 can equal 4 now. But having your arms wrapped around, what does the backlog and pipeline look like? What can the sales team do if we unleash them with more money or more people or better technology, right? So having an idea of growth, what it can look like if you received A, B, and C type of resources. I think, Erik, you hit on this first. Jessica, you also mentioned this, but absolutely spending the money to get your numbers in good working order. It's probably the third, fourth, fifth question that we'll have in terms of, hey, what does the momentum look like? And how easily can you put together these reports, or what is the dashboard that you use every day? That tells us a lot about how one runs his or her business. So spending the money there to get the financial house in working order. As much as it's very hard to time when you should go to market, because obviously life happens, but entering a time when you're in decent, positive financial momentum, again, may sound obvious, but in times like now, we're seeing a lot of quality, meaning a broad base of quality. So if you want to put your best foot forward, I think you should strive to enter the market where you do have good, positive financial momentum. Focus on delegating responsibilities to your team. So if your goal is to retire, 6, 12, 18 months after the transaction, you can physically retire, and the business isn't solely wrapped around you. And then I think both of the other panelists mentioned this, but these days, guys, there's so much capital, which for the business owner is great. Makes it hard on us as buyers, but it's great for you guys as business owners. So pick the partner who you genuinely like, and who genuinely understands your business. You will be in partnership with that person or with that group for a number of years. So I think it's just critically important, more now than ever before, given valuations and structures are at an all-time high, that you really pick somebody who understands the business and how it behaves in different economic climates.
Excellent, guys. Well, look, I mean, as much as I'd love to go around again for a surprise question or two here, I think we ought to call it there because we're right about the 30-minute mark. But I really appreciate all of you taking the time to join me today. Maybe we'll be able to rope you in for a round 2 sometime later this year to have maybe a bit more fun with some of the questions. But any closing remarks from any of the panelists before we let you go?
No,
Nope,
stay healthy.
that was great, Dan. Thanks.
Thanks for your
Super.
time.
All right, everybody. Well, thank you for the time, and thank you to all those that may be watching and/or listening to this. My name is Dan Mahoney, again with TruSight. My contact information is up here on the screen. Feel free to reach out with any and all feedback, questions, or concerns here. And just wanted to say thank you again. So appreciate everybody. Take care. All right, we'll let that run. Okay.